Nice to meet you guys. I'm
Kurtis.
excited to hear about what's going to happen this episode.
Yeah, I am too. My name's Kurtis, and I'm joined with...
And I'm Matt. And
today we're going to talk about a couple really interesting concepts going around in our economy right now, which is buy now, pay later, and payday loans. So Matt, why don't you kick us off by who are you and how are you an expert in this field?
So I am the director of underwriting and indirect lending at Canopy Credit Union. So I'm in charge of all things loan approval, basically. So I come up with the kind of the rules and that we play by is kind of like how I refer to it, the field that we choose to play in. And so, yeah, basically it's been 10 years since I started in the finance industry, and I have worked for other credit unions. I've worked for banks. I've dealt with mortgage-backed securities. I've done lending. I've done lots of different things on the finance side of things. And I'm just kind of genuinely curious about lots of stuff and when I see trends. So that's kind of how I got to where I am.
Yeah, you're well-versed in this area for sure. And you've spanned across from really big organizations that you've worked for to much smaller ones
Yes.
too. Have you noticed trends changing in terms of how people are taking on debt or borrowing?
Yeah. So the ease of the internet has really changed things a lot. So it's no longer, and especially I would say it depends on, I'm going to use the word vulnerability of the borrower. So how educated are they when it comes to stuff? But they, they're going to be online going for something usually because they're desperate. Okay. They're the ones that are going, I have a $500 bill. I need my money now. It's no longer, I want to find the best rate. You have borrowers that are well versed and they know, hey, I need to make sure I pay attention to my rate, pay attention to my payments and things like that. But it's the borrowers that tend to have no money in savings. They're the ones that are living paycheck to paycheck, and everything causes distress in their life. So it doesn't matter if it's $100 that they need for groceries or whether it's $1,000 to fix their car. And so for them, they're going, I just need the fastest solution. And the thing about the internet and Silicon Valley and I would say all these tech companies starting to get into this area is that they were the ones to respond first by saying, oh, you want money in your account? I'll put it in even though it's a Sunday. And I'm like, how do you put money in someone's account on a Sunday? I didn't even know that was possible. And working at the credit union, and it was like Silicon Valley was like, we figured out a way to do it.
Just instant funding.
So
Wow.
Yeah, so for them, they're like, it could be a Saturday. Our doors are closed, and they're like, I need this money. And next thing you know, they're like, well, I can get it in on Sunday, or I can choose to wait. Monday rolls around, it needs to be reviewed by someone. They go, I don't have time for it to be reviewed by someone. And they're basically willing to sign on the dotted line without really reading what is involved in the loan.
Now, is that an upward trend that you've seen just on the internet or in the last couple of years?
Last couple of years in particular. So I've been at Canopy now for, it's about 4.5 years. And it's just, it has J-curved. So when I was first, starting there, it was you were seeing kind of like these bigger names, like probably like SoFi, Lending Club, like these bigger name companies. And those aren't even the ones that I'm telling you guys right now are the problem. Like this is the part that made it so fascinating is that I started looking into those a long time ago, and I was like, oh, like they're not terrible. I mean, they're going to charge rates that are illegal for us to charge. But that's the part that makes it so sad is that the rates they charge are illegal for us to charge. The rates I'm about to talk to you guys about are illegal in the United States to charge, but they're being charged.
Who is not holding them accountable?
So it's going to be the rules and the regulations, the loopholes that they're able to use. And that's what allows them to charge the rates that they're charging, or because they don't fall under a traditional bank or a traditional credit union, they don't have like the NCUA, like for us that regulates us and comes in and audits us. You have
the same regulations.
FDIC, like you have all these government entities. I'm sure probably some of the other acronyms, but there's tons of other government entities that'll come in and make sure that you're quoting rates right and doing things like that. So
before we jump into that, what would be just your definition of being in this industry for so long? What's your definition of a payday loan? What is that?
Yeah, so that's a super interesting question, I guess. So a lot.
Let me ask one more thing in addition. Has that changed over time?
Oh my God. Yes, it has changed a lot. Payday loans, I would say like even 5 years ago, my understanding of payday loans was just, it's a short-term loan. It's not going to be the best, and it's going to be like Money Tree. Right. Like we've all heard of Money Tree. You guys probably all used to see like these like check cashing places on and have you noticed that they've disappeared?
Not really, but
okay,
I haven't been paying attention.
Yeah, okay, that's fair. But like I think as of right now, I think there's only one Money Tree location left in Spokane. Wow. But everything, if you go across the border to Idaho, you'll start seeing title loan places, check cashing places.
That's true.
Idaho has very different rules.
See, I would have thought it would have been because everything turned to apps. Because I get a lot of ads and stuff like that about you can, get your paycheck now. And
so Washington actually has really strict usury laws, and it's 18% in Washington. So if you're headquartered in Washington, it's illegal for you to charge over 18% on a loan, period.
Wow.
So if you're, in our case, we're governed under that. So we won't charge a rate over that. There's only one exception, and that's going to be a PAL loan, which is our version of a payday loan. And that one is at 28%.
Is there a federal percentage?
That's exactly what it is that for the PAL loans, we go off of a federal rule that has to do with federally regulated credit unions. And that's why we charge the rate that we do. But with
is it different than Washington's? Sorry.
It is, yes. And that's where we get the 28% number one, because when I first started working at Canopy, I remember I saw the 28% and I was like, what are you guys doing? We're violating laws. And they're like, no, here's the statute. Because every credit union I've worked for before was state chartered. We're federally chartered. I won't go down that rabbit hole, but it's different set of rules that we play by than
as a consumer. How would I know which one?
Honestly, you probably wouldn't unless you specifically knew to ask. Yeah.
And nor would it make a difference either for the average person.
Yeah. But sorry, payday loans.
Yeah. What's your definition?
So for me, it's anything that's short-term lending. I would typically say it's going to be, and by short-term, I'm talking like 45 to 60 days, is typically going to be my idea of a payday loan. And part of the reason why the short-term matters so much is because if you think about it, even if you're charging an egregious interest rate, to make your money back in 45 to 60 days is actually a difficult thing to do on a small amount of money.
I bet.
So what happens is that you have to charge an even more egregious rate in order to actually get the money that you need to justify your costs of paying employees and doing all those things. But also there's fees that they charge in there. So with payday loans, it's going to be also someone is going to be seeking it out, and it's for a lot of the same purposes like I mentioned in the beginning. They're short $100, they're short $300. So I would say it actually has more to do with the borrower's behavior and them basically creating a solution for that behavior. But it's all short term. It's all very poorly thought out, if that's a good way to put it.
That's a great way to put it. So I have a question then. So let's say I'm a individual who, and you mentioned it could be anything from $100 to $1,000. Let's say my check engine light came on and I need $1,000 on a weekend, and I see an ad for what would be a payday loan. What might be the risks of me taking that as a borrower from two parts? One, from my budget. So why is that maybe challenging for me in the long run? Because it feels like it helps right now. And then two, is there any risk or challenge to my credit score then with taking that loan? Or does that help it? Yeah.
So this is going to take us down a little bit different path, and the path is that not everything reports to credit. Okay, so it is fully up to a financial institution to choose whether or not they want to report to credit. And the thing about a lot of these payday loans is that and this is going to be kind of my personal opinion, and I'm sure the people in the payday loan industry aren't going to like it, is that part of the reason for them not reporting it is because that's how they keep you where they want you. Like, why would I report something to credit if it means that it's and say you pay it back, like you successfully pay back your $1,000 and it doesn't report to credit? Who else is going to lend you money? You have no history. It'd be like working a job and then not having that job on your resume, right? Like someone would just look at you and be like, well, you still have no experience. You're like, well, but I worked at this place for 3 years. And you're like, prove it. And they have no proof. So, in that sense, then taking out the loan, it could actually be, the fact that it's not actually helping you. It's not actually changing your situation or helping you progress to the next level where you can actually work with a lender that actually wants to give you like a reasonable rate. But the thing is that when they take out these short-term loans, a lot of times, for the $1,000, they're just looking at the immediate fixes, which is I need my car. But the thing is that if that person hasn't been able to save any money up to that point anyway, how can they now afford a $250 a month payment?
Yeah.
And that's the sad truth of it all, is that on $1,000, even on a short-term loan, you're talking about $250 a month. And usually what they really don't realize is that they're going to take out payments bi-weekly.
So it's $500.
So they're going to align it with whatever your paydays are, because they want to make sure they draw money out of your account the same day that money goes into your account, because they want to make sure that they're the ones that get paid and no exceptions on that. So
that's where it could come in to be really challenging. Then from your budget wise, it might feel like a short-term fix, but in reality, you might just be digging yourself further into a hole.
Yeah, and if you took like $1,000 loan, so say you wait until Monday and you go to an institution that's going to, let's say they charge you 18%. So Washington's usury rate. So even if you qualified 18%, I mean, the size of the payment difference that we're talking about for the same $1,000 could potentially be, it could potentially be like, just off the top of my head, like $80 to $100 versus $250.
Wow.
So the thing is that you do have the potential to actually have a better cash flow situation. And that's something that I don't think that we talk about enough, is the idea that you bring X dollars in, you have X dollars going out, and none of us can live when X dollars going out exceeds X dollars coming in.
Outliving your means.
Yeah, exactly. And it's just you can't do it. And some months people will have money left over. Some people, maybe they'll go into the negative a little bit, but you still can't go into the negative month after month and expect for things to be okay. It's just never going to work.
It's kind of like just the concept of financing your lifestyle, where you go into debt to, for better or worse, maintain the same status quo of your life.
Yeah. The example I've always used with our member advocates for the training purposes, I go, what if you had the best, let's say you had 0% interest rates on all of your debt, but you can't afford your payment. But what if I told you had a horrendous interest rate, but you could afford your payments? Like it's not a scenario where like you want to be like,
it's philosophical now, Matt.
Can't say it wouldn't be the first time I've done something philosophical, but yeah, it's just the idea that it's like, okay, you may not like that you're paying a high interest rate, and that's the other thing too, is that they'll get people so focused on the interest rate that I'm like, but what's the point if you can't afford your payment? Yeah. And it's not that I want you to be stuck at a bad interest rate. It's just that I can't have you not making enough money to survive, because there's never a good outcome from not having enough money to survive. But there is a potential okay outcome from paying a really high interest rate.
Sure. Okay. So we've heard 18%, we've heard 28%, a couple numbers thrown around. What would be an average payday loan interest rate? So what are some ones that might be standard, and what have shocked you?
This is my favorite question to turn around and ask to other people. What would you, so like, I'm going to use the word like predatory. What would you say is a predatory interest rate? Like if you heard, 10%, if you heard 20%, like at what point does your brain just kind of go like, whoa, that just doesn't seem right?
I would say probably like 15.
15%?
I don't like 15.
Okay. Yeah. So Kurtis?
Yeah, I would say somewhere around like 17 and up. Okay. Feels really icky.
Which and I can definitely.
That 18. Washington's gotcha.
Yeah. So I have actually next to me here, I brought a couple of examples. And here's the other thing about predatory loans, is that they never actually tell you very clearly until you get to sign on the contract what your rate's going to be. And also they will hide it as long as they can. But what if I so I went down that path that I was mentioning earlier about the what I call the dark rabbit hole of of payday loans and how people get
Yeah, it
into
sounds like
these
a
online.
cycle.
Yeah, and the problem is that it's not just one company. There's probably 50 to 60 companies that are doing these, and so the highest interest rate that I saw was 780%.
Wow.
Oh my god!
Do you remember on how much?
Yeah, and usually the higher percentages will be tied to lower dollar amounts. Yeah, and then I'd say like if you were talking like $2,000, $3,000, you're talking about 400%. And so yeah, these companies, it's wild. So I had a member at work, and this is probably the best way to explain this, and she had. I believe it was something like 8 payday loans came out of her paycheck hit her account. And by the end of the day, she had no money left in her account.
Wow.
And she was getting close to defaulting on her car loan with us, her signature loan with us, because and the thing was is that she didn't understand. She's a very sweet person, but she doesn't see numbers, the way that probably I would say that I do.
Because she's not actually physically paying them, right?
Correct. It's just coming out of her account automatically. And so the thing is that, my first mark of what a payday loan company is going to do is they're going to name it something that sounds really pleasant. Okay. So for example, one of the ones I have with me over here is With You Loans.
Oh.
Okay.
I'm never alone.
Yeah, exactly. And that's the thing
Yes.
is you go onto the website and it's got like videos of people like skipping through fields and rainbows in the background. And it's so abysmal. Like it just, after this, we'll have you pull up some of the ones to look at. Bright Lending is another one.
Smart.
Ascend Loans.
Oh.
Right? Like you're ascending.
Climbing the ladder.
Yes. And so anytime you see something that's named pleasantly, it's not very pleasant.
Red flag.
It's total red flag. Okay. And so this member had like 8 of these coming out of her account. And she just didn't realize that she was, borrowing from taking from Peter to pay Paul, right? Like she just basically got herself into a cycle where it wasn't going to end well. Yeah. And so I started asking myself, okay, well, like, how did they get her? Like, did she go online and say, like, pay, like predatory payday loans? How do I access these? Right? Like it's just no one does that.
Loan
right?
Shark in my area.
Yeah. Is there a loan shark?
How did she even qualify for the other loans?
So the other thing about a payday loan is that they're not going to pull your credit. Okay. Or they're going to say that they're not going to pull your credit and they're going to do a soft pull, because here's the other one that's really going to.
What's that?
So a soft pull is when they, like, whenever you see like a creditor or a lender that says, hey, it won't hurt your credit, like it won't show up on there or something like that. That's going to be a soft pull where it's like, yeah, we're going to look at it, but we're not going to leave a mark on here that says that we inquired on it.
Okay.
And so, on these, and I don't say this as like a bragging thing. I promise I'm much more modest than this, but when I started down this path, I have on my Savvy Money app, so I can go in and see what my credit score is.
Yeah.
And I have an 801 credit score, and I
Nice.
try to avoid borrowing.
Yeah, it is.
And,
Congratulations.
What's the max credit score?
850.
Okay.
And
That's
usually,
really high,
and usually I don't see people over like an 820. And usually once you're over a 740, I'm like, you've made it. You don't need to worry about it anymore. But,
made it.
Yeah. But with these loans, so I went to these websites and I started applying. I was denied.
You applied.
Oh, I applied for these loans because I'm.
Yeah, you're curious.
And I mentioned I'm ornery. So this is like 2:00 in the morning, and I won't curse, but I was kind of pissed off and
sick of it.
And I hate seeing people getting taken advantage of. I do believe that certain people have earned the right to pay a higher interest rate. I don't believe someone has the right to just be completely screwed. Like it's not cool.
Well, it's not cool for our whole society.
Correct. Because
what's the end goal for that?
Yeah. And that's, I think that's something that I've started thinking about a lot since I started working Canopy, where I'm like, if we don't do something about helping people, it's going to come back on us, right? Like at some point, everyone else, no matter how good you're doing in life, you're going to have to pay the price for someone else not doing well in life. So the last thing I want to do is leave someone worse off than when we found them.
Yeah,
right?
especially if we have the opportunity to educate or help or
So
and the
on,
resources.
So on these though, I was denied for more of these loans than I was approved for. Now I'm going to turn. I want you guys to. I'm going to ask you this as a question. Why?
So do you think it's because your credit score was too high?
I think that's a component of
you
it.
were to, well, one, you probably were a borrower that they don't even look at typically, right? And
Got
so your
screened
interest
out
rate would have
somehow?
been either much lower than that would have been worth their time to fund. And two, I'm guessing most of these lenders, if we want to call them that, don't expect people to make all of their payments back in full, right? They expect people, they will make enough money to make it worth their time. And they knew you would make.
You make this much money, you should be able to afford your bills. But because we know that we're going to draw the money out as soon as it hits your account, we're going to get paid. And your other creditors, I don't care about them.
Sure.
Right. So, but yeah, I found that one really fascinating that I would get denied. And I remember this is like 2:00 in the morning, because I tend to do this stuff really late at night. And I chatted with like a customer service person, because all it tells you is you're denied. Oh. It didn't give me any reasons. And I'm like, I just kind of want to know why I was denied for this loan. And the person in the chat basically gave me like the most vague answers in the world, where they're like, well, like you can apply again in 30 days. And I'm like, well, but I want to know what I did wrong. And they're like, that's not something we can talk about. Oh. And so I'm like, okay, so like and just for perspective, when we deny someone, we have to send a denial letter. That explicitly states what you were denied for. Like we have credit reasons that you have to be denied for. And I was like, well, how are they getting away with not doing that? And the thing that also, again, is the mark of payday lender is that you have to kind of dig deeper. And like, for example, I'm going to pull this up because I don't want to butcher it as I say it, is that in the fine print on some of these, it says, With You Loans is a tribal lending entity wholly owned by the Oto, Missouri Tribe of Indians, a sovereign nation located within the United States of America, and is operating within the boundaries of the Oto, Missouri Reservation. And it's regulated by the Oto, Missouri Consumer Finance Services Regulatory Commission. So they're not subject to U.S. laws when it comes to the rates that they charge. And so the thing is that's hidden in the very last paragraph of the letter that you get that says you're approved. The money is yours. It's fast and easy and secured. And your fast access to funds, no early payback penalty, no hidden fees, 24/7 online access. So like they hide it behind all the pleasantries of what people are like, oh, well, this isn't that big of a deal. I can pay it back whenever I want. Yeah. And so but the thing is that there's like 50 or 60 entities across the United States. And the thing I want to make very clear is it's not just on tribal reservations. Yeah. We saw one the other day it was like the Bank of Utah. And I'm like, the Bank of Utah, like what the heck are they on those?
They're operating in the United States.
Yes, they are operating in the United States. And what they did is, instead of charging you an interest rate, they charge you a daily fee. Oh. And so when you calculate
same but different.
When you calculate out the fee, it worked out to be like 700-something% interest. So the thing is that it's not just one entity doing this. Like it's everyone is finding their loophole into it. Yeah. And that loan that we did when it was a borrower who had to get her car engine fixed, and it was actually kind of outside the guidelines of what I would normally have allowed. And the reason why I ended up saying yes was that she had made all of her payments on time for 6 months biweekly. She had actually paid almost the entire principal of the loan back, but had only paid down the balance like $300.
What is the principal of the loan?
No.
So principal will be like the amount that you borrowed. So if
Okay.
you borrow $5,000,
Nice.
your principal of the loan's $5,000. And like in her case, it was like $5,000, but her balance remaining was $4,700 after 6 months. And her monthly payments.
And she paid on time.
And she paid all of her payments on time.
So going back to your question, if she had had that 0% loan, in theory, and that
she in theory would have been
almost be
paid
done.
off, right?
Yeah.
But her interest rate was so egregious that it was like, and Kurtis pointed it out earlier that a lot of these companies, their hope is that you just pay long enough, because all it takes is 4 biweekly payments for them to make all their money back, all their principal back. So you borrow $500 from them and they do it over a 6-month term. Within 2 months, they're made whole.
Wow.
They have all their money back.
Anything else is just extra.
So you make one extra biweekly payment, and we could go in and do the math and be like, okay, well, that works out to still be like 100%, interest rate, right? So they sad to say, they plan for failure. Like
Wow.
it's not that they hope you fail. They hope you pay it off, because then they make even more money.
Sure.
But they definitely make it set up to where they're like, we expect that we'll be able to collect this many payments back. And after that, everything else is just icing on the cake.
So going back to your earlier point of just like, if you don't have a job on your resume that you've worked, it's not helping you. So if I pay off a payday loan, that is not necessarily going to be on my credit report. If I don't pay off a payday loan though, and I fail to pay it off and start missing payments, will they then add that to my credit report?
So actually the gal that I mentioned earlier that had like the 8 payday loans, I touch base with her usually like once a month or so, because she's been getting caught up on her payments and she's been doing a really good job of it. But I noticed that a payment came out of her account for what looked like one of the payday lenders, because we had to like set her up with a whole new account, and we had to change a lot of things so they could stop drawing money out of her account. And I saw the new payment coming out, and I call her. I'm like, hey, I don't want to make it sound like I'm accusing you of something, but we talked about how important it is to not go back to using these lenders. And she goes, oh no. She goes, I did not go back to using them at all. She goes, they threatened to garnish me. That is the fastest I have ever seen a company go from her paying to not paying, and then being like, we're going to garnish your wages. But what they did was they said, if you're willing to make this number of payments back, and they gave her like a super reduced payment for like the next like 4 pay periods.
Okay.
They said, then we'll call it good. Well, they had already collected enough interest and principal on it that basically what they did was they said, let's make it so attractive that as long as you can pay this back to us, we're doing real good.
Yeah.
So that's kind of the sad part about it. And so she goes, hey, it was either they're going to garnish me for this much money, and garnishments, people don't realize, but when you get garnished, it's not a pleasant hit that they usually give you. Like it could be that you have this really small debt, and it could be that they say, hey, we're going to garnish you for, it's $1,000. We're going to garnish you for $300 out of your paycheck. And it's like, person goes, I can't afford that. And that's basically what she was faced up against with that.
So not necessarily that they would report to the credit bureaus that payments weren't being made, but more of they would just go straight to that person's HR, essentially, or place of work, and take their paycheck.
Correct. Yeah. Because a garnishment, like,
Is that even legal?
And that's the thing about a garnishment is that, so like as a financial institution, if we're hit with a garnishment, we have to comply. Like it's federal law, because it's a legal, they filed something with the courts. They probably have, I bet you they have some relationship with the court in their area. I mean, now I'm going on to a little bit more of what my opinion is. But the thing is, I'm like, how did they know? Like, we can tell you from our perspective, very rarely is Canopy ever getting to that point, even on the loans that default. Like it's usually not worth the time. 2, you're also usually talking to someone where they're already struggling in some capacity, right? Like what am I going to do? Make someone's life even more miserable than it already is? Like, it's just not. There may be times that we do it, but if the times that we do it, it would need to be someone that clearly was trying to do something to take advantage of us. That might be a reason why we would do something like that, but not someone who like, hey, I fell on hard times. I was diagnosed with cancer. Yeah. What am I going to do? Go throw a garnishment against them? That's not the way that we do things. So, But
Thank gosh.
yeah, well, and it just really surprised me to see that they were willing to do a garnishment. But if it doesn't go to a garnishment, it can still go to collections.
Okay. Do you think that they did such a high turnover for her because she was making her payments?
Yeah, because I'm sure
They
that what
knew
they
that
do
she
is
had it.
they probably looked at it and said, "We made this much money. Let's see if we can get a little bit more out of it. This is worth our time to do this." I mean, I'm sure that there's a mathematical calculation that they use.
Yeah.
Because and when you think about it, it's kind of like what a collection agency does. The collection agency's goal is to get as much money out of you as they can. And I know that this is an area that Kurtis is very much. I go to him when it comes to this. Actually, I just went to him the other day on a collection thing where I'm like, what the heck is going on here with this guy? And they're trying to maximize whatever their return is. Now, whether or not they're doing it ethically and doing it properly is a completely different question. Their hope is that you're just not educated enough to know that you have
bully
rights.
their way
into,
They bully
Is
their
there
way.
financial ethics classes? Because there's a lot of ethics classes in my schooling, and
Yeah. I mean, I would, it would be nice, but
there's not.
no, I mean,
Really?
I mean,
Wow,
I
I
don't know.
think that-
Curtis did it.
Perfect.
Yeah.
Gonna develop that class.
not that are. I mean, we teach financial education workshops via Canopy, and that really just focus on like the maybe harder challenges of finances, so collections or credit repair. So we try to meet people where they're at, and then in those, then we'll empower them with saying, if it collect, I mean, sometimes it's not even worth playing a collection if you're in the right position or the collection doesn't make sense. And so we'll have those more empowering conversations then, and what they can and can't ask, and what you have to and don't have to provide, but not taught in terms of like in school or anything like that, which would be great, because that would be, I mean, this is a topic that is becoming more and more relevant, as you mentioned, in your 10 years of experience. This is probably that J curve upward. But yeah, it's concepts and topics that need to be discussed more.
Yeah, definitely. I mean, I have my education in education and also in the medical field.
Yeah.
And both of those we had to take like ethics classes. And,
for sure.
I feel like this is right there.
Well, that kind of goes to your early point where it was, these aren't banks or credit unions that are doing this. These are very much those entrepreneurial companies that didn't have that foundation in an ethical concept of, hey, this is why we're being founded.
Right.
It was founded of, this is a gap that we can fill and charge a lot of money for.
And actually, that kind of brings me on to the second one that I got here. I got this letter. So, of course, now I'm getting a bunch of spam letters, right, from these places. But RTA loans is the name on this one. And with RTA loans, the thing that's interesting is that when you read the fine print at the bottom, RTA loans is not a lender and does not make loans.
They're just a pass through.
So it was like, wait a minute. You call yourself RTA loans, but you don't make loans. And I'm like, okay, so tell me more. And then it's like, we don't even make credit decisions. All this company does is find loans for these lenders. And so when that was part of that rabbit hole that I went down, was that as I started searching for these places online, what I found was that it wasn't so much that it was taking me directly to that company's website. They were hiding it more so behind a veil where you don't even actually like, it's you type in your information and then it spits out your application, and it'll start being like, hey, we've had one lender look, two lenders look, three lenders look. I think the one that I finally got this with you loans from was, I think it was like 13 lenders have looked, and here's your options that you have. But usually what it does is it for me anyway, it was just like, it wasn't like, here's your 13 options. It was, here's the one that has the best deal. So with that, can you guys imagine what my concern with that part might be?
That it's not the best deal.
Yeah.
Because
It's not showing you all of them.
maybe what the best deal is that a
fine
company
print
like
in there.
RTA Loans goes, With You Loans is willing to pay me more money in order to fund this loan. And so then you're like, well, wait a minute. So
Whose best interest do they have in mind?
exactly, we found the best deal for you here. No, it's the best deal for you. It's might even possibly be the worst deal for me, because how are they going to pay you more money if they're not charging me more money, right? But that would be kind of where the Silicon Valley piece comes into play, is that they're making almost like, I'm guessing like algorithms or engines that aggregate people's information and then spits it out, and then they go, "Hey, I was just the finder fee, right?
Sure.
Like I didn't do anything."
Don't blame me.
Going back to your ethics piece, right? Like they can just sit there and be like, "I didn't do the loan.
Yeah.
I didn't make the credit decision.
Yeah.
All I did was I just found you some options, and you chose the option, and now it's off my plate." So it's kind of like a clear conscience type thing, even though I don't think that's a very clear conscience in my opinion.
That's wild. So there is no federal regulation system for any of this?
No, not when it comes to the internet lenders and what we would call like, it's like we're like brick and mortar, right?
Yep.
And that would be like, yes, we have an online presence, and yes, we do, tons of our loans, we take applications online and stuff like that.
Is Canopy just Washington?
Yeah.
Yes. Okay. Yeah. But we're still regulated in that sense. So you can even have, really large institutions like, I think USAA is a good one, where USAA doesn't have a ton of brick and mortar. In fact, I think they just have the one location where everyone works out of in Texas. It's like this massive building that has like a mall in it or something like that.
Believe it.
But they're huge, but they make it so that but the thing is that they're still regulated because they're a bank. Right.
Yeah.
So they have a lot of rules that they have to play by, and that's actually, if you've noticed, I actually used to work for Umpqua Bank, and if you saw Umpqua and Bank of Columbia recently merged together, part of the reason why you see these mergers happening is because it's really difficult for them to actually pay all the administrative costs for complying with all these rules. So part of what you have to do sometimes is they get to a certain asset size. Your asset size dictates how regulated you are. So like a JP Morgan, for example, is going to be very heavily regulated. And the reason why is because if JP Morgan goes down, just like this whole Silicon Valley banking crisis that happened with, what was it? SVB, I think Silicon Valley Bank. If Silicon Valley Bank goes down, you saw the chaos that started happening from there. Now imagine if JP Morgan goes down.
Yeah.
The government can't have that. So the government goes, well, JP Morgan, we got lots of rules that you get to play by. Well, your asset base that you have helps you absorb those costs. So as your bank gets bigger, you basically have to find ways to absorb more of those costs. And a lot of times it means merging with a competitor. So
yeah, Gisa just merged with somebody.
I know which credit union was it. I know which one it was. I can't remember it off the top of my head. Yeah, we'll add them there. So
okay, I have a question for you. So, this will be, let's do it as a elevator question. So I'm getting in the elevator with you, and you have 60 seconds to convince me to not do a payday loan, and maybe what the best alternative is. If I just keep getting mail like you're getting, I'm like, well, this makes sense. I mean, I'll get approved. Why shouldn't I get that $1,000 payday loan? And what other options would I have?
So the first question I would always ask someone is, what is it that you are needing a payday loan for? Like, is this something that is truly like an emergency? You do need it right now. It's the kind of take a deep breath, collect yourself, and go, how immediate is this problem? Second thing I would say is that if it's something that doesn't need to be done right now, and even then, even if it needs to be done right now, if they say, hey, well, there's going to be a fee involved if I don't pay it, that fee is going to be so minimal in comparison to what you'd end up paying on that payday loan that, frankly, your next option would be, okay, just wait till Monday, apply for a loan. But if I told you, okay, well, your monthly payment is going to be something you can't afford anyway, then you would say, okay, I need the $1,000. Okay, but your payment's going to be $250 a month. If your next response is, well, I can't afford that anyway, well, then why? Now you're doing something that also causes you pain.
You're getting into that cycle again.
Yeah, exactly. So it's really, I guess the best argument is if you can find other ways to offset the issue, that would be the way I would go. So what I always encourage people to do is set aside some money in your savings accounts. And so if it's an immediate thing, I get it that telling someone to set up an emergency savings account probably isn't going to mean a lot in the moment.
You start this 6 months ago.
Yes, exactly. But if when it comes to someone's budget, I'm also going to say, sit down with me in your statements and let's see how much money you actually do have to be able to make this payment. But it's the idea that if you need to pay $250 a month and you can only afford $100, clearly this isn't going to work.
Yeah.
Right.
Yeah.
So, probably it's a tough question to answer because it so depends on the circumstance that the person has.
Sure.
But most of the time people think finances make people stressed, and stress makes you do things that aren't very smart. And so for me, it's the idea that part of the reason why I keep an emergency savings the way that I do is because if I don't have that money, I'm going to make bad decisions. If I'm going to make bad decisions, it's just going to make things worse. And I can speak from experience. I just got my wife's bill because we just had our baby boy about a month and a half ago. And thank you. And he was born a month and a half early.
Okay.
So he was in the NICU for like 16 days and I got that bill, and I can't tell you how much stress I would experience if I got a $6,200 bill from Providence saying, we need you to pay this now. I like, for me, I'm stressed out about thinking about it, even though I already paid it. Right. So now it's
Flashbacks.
like, and now I don't expect that the average person is just going to go, I'm going to set aside $6,200 and whatnot. Like I'm a realist in that sense. But if everything causes you stress, if $100 not being there is going to cause you stress, then it's worth saving the $100 and foregoing something else, because the level of stress that you're going to experience will far exceed, the benefit that you're going to get, or the additional stress, I guess, that you're going to get from taking out a loan that you can't afford to pay. Yeah. So,
which kind of sounds like what payday loans are set up to do as their premise.
Yeah. And that's the thing, is that they will make you want to repeat them. Right. Like it's, and I mentioned earlier, like we have a 28%, rate on ours. If you take $1,000 loan out with us at 28% and you pay the $20 fee that we charge that goes with it, and then you take the full 6 months to pay it back that we allow you to do, on $1,000, your total amount paid back in interest would be somewhere in the neighborhood of about, interest and fees would be somewhere around $130.
Okay.
If you do $1,000 from one of these payday loan places and you take the same 6 months and it's set up on biweekly payments, your payments are going to probably be about triple what your payments are going to be with us. And by the time it's done being paid back, your $1,000 is probably going to cost you somewhere in the neighborhood of about, like, I'm going to guess around $2,100, $2,200. So you can pay back $1,130 to borrow $1,000, or you can pay back $2,100 to pay back $1,000.
Yeah. Wow. That's crazy.
So, and then now compound this by people doing it multiple times.
I was gonna say
that's
8 times or something like that.
That's the part for me that is so bothersome to see, is that it's I don't even necessarily blame the people as much, because another thing about these, and I mentioned I do like really crude YouTube videos, but I actually did a video of me walking through a predatory loan, like the paperwork.
Yeah.
And in it actually, in the language, it and I'm going to paraphrase, but it said, this loan may not comply with your state's rules and regulations for interest rates. If you would like a loan that complies with your state's interest rates, find a different lender.
Oh my gosh.
Yeah. So as you're going through, and the thing is that the other thing about these like online loans is that because it's all just clicking, and you don't have someone sitting there and explaining it, you like for us, like a lot of times if people are coming in, I would sit down with them and I would be like, I'm going to make you understand like how bad this is, right?
Yeah.
Like, or like the severity of the situation. For them, it's like, oh, sign here, like, or maybe like you sign one time and then it goes, click this box.
2 minutes.
Click this box. Click this box. Your loan's funded. You know, like just stuff like that just makes it to where it's
Ascent lending, and we will rise together.
and we will rise. Seriously, they
elevate your life today.
By the way, I'm pretty sure Elevation is another lender that's out there.
Not surprised.
It sounds like it is, at least anyway. But yeah, so.
No, that's powerful. Thank you, Matt. Thank you for telling us more just about payday lending. And this just seems like it's becoming more and more of a severity in terms of the populations that we get to work with, and being able to educate people on alternatives, the risks of them, and ways to get out of them if we are in them is a powerful resource. So thank you.
Absolutely.
Yeah. And as a last thing, I think the best thing, kind of going back to your elevator thing, if you are going through something, one, there's no shame, right? In something, your car breaks down. There's nothing shameful about your car breaking down. But just ask someone, right? It's the idea that the internet has taken away part of that human connection, and that human connection is what can help stop you from doing something that you would otherwise regret, right? So it's it may feel like something that's really hard in the moment, but just go ask someone and go, hey, this is what I'm experiencing. These are some of the offers that I've had. Like you can run calculations. It's super easy to compare it, but definitely take a deep breath, stop, think about it for a few minutes, because there's nothing that's worth ruining your life over. And that's literally what these loans can do.
Yeah.
Yeah, absolutely. Thank you for leading the charge on the war against payday lending.
Yeah. And we got to do something about these ethics classes. For sure.
Yes, I would.
And federal regulations.
Yes. Yeah, exactly. So the tech sector, I'm sure that at some point something's going to happen.
Good.
Because that's why you also see a lot of these Silicon Valley banks, they buy banks, and I know that we're probably trying to end here, but they actually like Lending Club bought Radius Bank, but they still operate Radius Bank as a separate institution, and they use Radius Bank to do all of the funding of the loans, like the distribution of the money to make it happen. But Lending Club still does all of the loans. So the thing is that Lending Club isn't regulated, but they own a bank
that is,
and that gives them all the deposits that they need so they can charge higher interest rates. But not have to pay the same regulatory costs.
Yeah, and it confuses the consumers.
Yeah, well, and that's the thing. Most consumers don't even know what's happening, right? Like it's just that for them, it's everything that they do is strategic. We were talking about like the entrepreneurial spirit of it, right? Is that they're going into it going, okay, here's a rule. How do I exploit it? And that's the going back to your point about the whole ethics piece. It's like, okay, well, here's a rule. I could exploit it, but that's probably not a good thing to do. Would be a better response. So.
Yeah, absolutely. Well, right on. Thank you, Matt. We appreciate it.
Yeah, thank you so much.
Thank you for having me. I love this stuff. So talking about it and helping people know more about it. I don't love predatory lending. Just to be clear.
Definitely clarify that for us.
Just to be clear. Thanks, guys.
Thanks, Matt.